Let me be direct with you tonight. The skills that actually create millions, the ones that truly separate the wealthy from everyone else, are not the skills you have been taught in school. They are not about positive thinking. They are not about taking massive risks. And they are definitely not about following your gut feeling. They are mathematical principles disguised as human behavior. And tonight, I am going to share 7 of them with you. The exact 7 skills I have observed in every single successful wealth builder I have ever known in my entire career. Before we even begin, you need to understand this. What I am about to tell you contradicts almost everything you have ever heard about making money. And that is completely intentional. The conventional wisdom about wealth was designed by people who do not have it, for people who will never have it. If you want different results in your life, you absolutely need different thinking. So let us start with the first skill, and I will warn you right now, is the one that makes most people deeply uncomfortable. The first money skill that rich people actually use every single day is this. They treat uncertainty as a mathematical problem, not as an emotional crisis. Listen to me carefully, because this is where most people lose the financial game before they even get a chance to start playing. When you face a financial decision, your brain immediately floods your body with feelings. Fear of losing what you have already accumulated, excitement about what you might possibly gain, anxiety about making the wrong choice, and looking foolish. Rich people, the ones who actually build wealth and keep it for generations, they feel those exact same emotions. But here is the critical difference. They do not let those emotions make the final decision. Let me tell you about a pattern I noticed very early in my career. I was working with brilliant mathematicians, people who could solve complex equations that would make your head spin just looking at them. But when it came to their personal finances, many of them made absolutely terrible decisions. Why? Because they treated their own money completely differently than they treated their work. At work, they demanded proof, they demanded evidence, they demanded rigorous testing. They would never accept an answer without data. But with their money, they relied on instinct, on what felt right in the moment, and they lost money consistently because of it. I learned something profound from watching this contradiction play out over and over again. The human brain is not wired for financial success. It is wired for survival in an environment that no longer exists anywhere on Earth. Your instincts were designed for immediate threats and immediate rewards. A rustle in the bushes meant run now, think later. A piece of fruit meant eat now because it might not be here tomorrow. But building wealth requires the exact opposite response. It requires you to ignore immediate threats that are not really threats, and to delay immediate rewards for much larger future gains. Your own biology is working against you every single day. So what do rich people do instead? They create systems that remove emotion completely from the equation. They do not ask themselves, how do I feel about this investment? They ask, what does the actual data say? What is the expected value here? What is the probability distribution of possible outcomes? Something that most people cannot. They accept that they cannot predict the future. They can only calculate probabilities and position themselves to benefit when the odds are in their favor. Think about it this way. If I offered you a simple coin flip, where heads you win $120 and tails you lose $100, would you take that bet? Most people hesitate when I ask this question. They immediately imagine losing that $100 and it feels terrible in their stomach. But mathematically, this bet is a gift. Over many flips, you will absolutely make money. The expected value is positive $10 per flip. Rich people see this instantly. Poor people feel the potential loss, and they walk away from free money. That, my friends, is the difference. The second skill, and this one might really surprise you. Rich people are obsessed with being wrong, not with being right. Let me say that again. They are obsessed with being wrong, not with being right. This seems completely counterintuitive, does it not? Shouldn't successful people be confident, certain, convinced of their own correctness? No, that is exactly backward. Confidence in your opinions is expensive. Doubt is profitable. Let me explain what I mean. Early in my hedge fund career, we built trading systems based on mathematical models, complex stuff, patterns in market data, statistical anomalies, predictive algorithms, and here is what we discovered very quickly. Every single model was wrong. Every single one. Not sometimes, always. Models are simplifications of reality, and reality is infinitely complex. So if all models are wrong, what is even the point? The point is, some models are useful, and the only way to figure out which ones are useful is to constantly, relentlessly test them, challenge them, and discard them immediately when they stop working. I will tell you about a specific moment that crystallized this for me forever. We had a trading strategy that had been profitable for months, solid returns, consistent performance, then suddenly it started losing money, not a lot, but steadily, day after day. Most organizations, most people would have stuck with it. After all, it had worked for months. It had a track record. It felt right to keep going. We killed it immediately. Why? Because the data had changed. The pattern we were exploiting had completely disappeared, and our commitment was not to the strategy itself. It was to the process of following the data, wherever it led us. This is what rich people understand, that others simply do not. Your ego cannot be involved in your financial decisions. When you attach your identity to an idea, when you need to be right to feel good about yourself, you become blind. You start cherry-picking information that confirms what you already believe and ignoring information that contradicts it. This is called confirmation bias, and it is a tax on your wealth. Every single day you pay it. Every decision you make, while blind to contradictory evidence, you pay it. The wealthy have a completely different relationship with being wrong. They expect it. They plan for it. They create systems to detect it early and correct it quickly. When someone shows them data that contradicts their position, they do not get defensive. They get curious, because that contradiction might be the most valuable information they receive all year. Being wrong quickly and adjusting is far more profitable than being wrong slowly while pretending you are right. The third skill: rich people think in bets, not in certainties. This is a fundamental shift in how you process the world, and most people never make it in their entire lives. Listen to how people talk about their decisions. They say things like, "I know this will work," or "This is definitely the right move," or "I am certain this is a good investment." These statements reveal a dangerous misunderstanding of reality. You do not know. It is not definite. You are not certain. You are guessing, and that is completely okay as long as you know you are guessing. Every financial decision you make is a bet. When you take a job, you are betting that the salary and experience are worth more than the opportunities you are giving up. When you buy a house, you are betting that the value to you exceeds the cost plus the alternative uses of that money. When you invest in a stock, you are betting that it will return more than other available options. Rich people think explicitly in these terms every single time. They ask themselves, what am I betting here? What are the actual odds? What is my edge? And critically, what is the cost if I am wrong? Let me give you an example from my own experience. When we were developing new trading patterns, strategies, we never bet everything on one approach. Never. Even when we had high confidence, even when the back-tested data looked absolutely beautiful, we allocated carefully, because we knew no matter how good something looks, reality has a way of surprising you. The market is not obligated to behave the way your model predicts. So we diversified not just across assets, but across strategies, across time horizons, across everything we could. This is what professional gamblers understand, that casual gamblers do not. It is not about individual bets. It is about the portfolio of bets over time. Make the right bet and lose. That is called bad luck. You can make the wrong bet and win. That is called getting lucky. Neither one teaches you anything useful. What matters is making mathematically sound bets consistently and letting the law of large numbers work in your favor. Over time, with enough repetitions, good bets pay off and bad bets do not. But you need enough capital to survive the variance in between. Here is the practical application for your life tonight. Stop thinking in terms of right and wrong decisions. Start thinking in terms of expected value. If you have a decision with a 70% chance of a $10,000 gain and a 30% chance of a $5,000 loss, your expected value is positive $5,500. Make that bet every single time. You will lose 30% of the time, and that is completely fine. Over many similar bets, you will come out way ahead. This is how casinos make money. They do not win every hand. They just make sure the odds are slightly in their favor, and then they let volume do all the work. The fourth skill, and this is where it gets really interesting, rich people exploit inefficiencies that everyone else simply ignores. Markets, businesses, opportunities, they are all filled with tiny inefficiencies, small gaps between what something should cost and what it actually costs. Brief moments when supply and demand are out of balance, situations where information is unevenly distributed. Most people never notice these gaps, and the few who do notice them think they are too small to matter. Rich people build entire fortunes on these tiny gaps. I will tell you exactly how this works. In financial markets, there are thousands of participants, all with different information, different time horizons, different motivations. This creates constant small mispricings. A stock might be worth $100 based on all available information, but it is trading at $99 because a large institutional investor needs to sell by the end of the day for regulatory reasons. That $1 gap, most people think $1 does not matter. But if you can identify thousands of these $1 gaps and exploit them systematically, you print money. The key word is systematically. Rich people do not look for one big score. They look for repeatable patterns they can exploit over and over, because one big score is luck. 1,000 small scores is a system, and systems are what create reliable, lasting wealth. Here is a non-financial example that illustrates the same principle. I knew someone named Cool Joe who noticed that textbooks for college courses were incredibly expensive in college bookstores, but cheap on the used market at the end of each semester. Obvious, right? Everyone knew this, but here's what everyone did not do. Cool Joe created a system to buy used textbooks at the end of spring semester when students were desperate to get rid of them, store them over the summer, and sell them at the beginning of fall semester when new students desperately needed them. Simple arbitrage, buying low when supply is high, selling high when demand is high. Cool Joe made more money from this in college than most of his classmates made in their first jobs after graduating. The inefficiency was obvious. The opportunity was available to everyone, but only Cool Joe built a system to exploit it consistently. That is the difference. Rich people do not just notice opportunities, they build repeatable processes to capture them. And they understand something crucial. Inefficiencies exist because most people are lazy, most people are emotional, and most people do not think mathematically. That is your edge. The fact that you are willing to do what most people will not. That is literally where profit comes from. The fifth skill. Rich people master the mathematics of compounding, and more importantly, they avoid its evil twin, erosion. Everyone has heard about compound interest. Einstein supposedly called it the eighth wonder of the world, but hearing about it and truly understanding it are completely different things. Let me explain what compound growth really means, because most people fundamentally misunderstand it. If you invest $10,000 at 10% annual return, after 1 year you have $11,000. After 2 years, you have $12,100. After 10 years, you have almost $26,000. After 30 years, you have $175,000. $174,000. After 50 years, you have over $1,100,000. Same initial investment, same annual return. But the difference between year 10 and year 50 is exponential. That is compounding. But here is what most people completely miss. Compounding requires two things that are very hard for human beings: time and consistency. You cannot interrupt it. You cannot borrow from it. You cannot pause it and restart it. Every interruption resets your progress. Think about it this way. If you invest $10,000 at 10% for 50 years, you get $1.1 million. But if you invest $10,000 at 10% for 25 years, pull it all out, and then start over with another $10,000 for another 25 years, what do you get? You get two separate piles of about $108,000 each, so roughly $216,000 total. You lost almost $900,000 by interrupting the compounding. Same money, same return, same total time invested, but the interruption cost you almost $1 million. That is the power and the fragility of compounding. Now let's talk about erosion, the thing nobody wants to discuss. Compounding works in reverse too. Fees, taxes, inflation, bad decisions, they all compound against you. A 2% annual fee does not sound like much, does it? But over 30 years, it does not just cost you 2% times 30. It costs you almost 45% of what your ending wealth would have been. Because you are not just losing the fee, you are losing all the future growth that money would have generated. This is why rich people are absolutely obsessed with costs. Not because they are cheap, because they understand the mathematics. Every unnecessary cost is stealing from your future compounded self. Here's a real example. I have seen people pay financial advisors 1% of assets annually for advice that could be replaced by a simple index fund on a $1 million portfolio that is $10,000 a year. Does not sound devastating, right? But over 30 years, assuming 7% market returns, that 1% fee costs you approximately $630,000. You paid what felt like a small ongoing cost, but you actually paid more than $500,000 in foregone compounding. The advisor got rich, you stayed middle class. That is mathematical illiteracy at work in your life. The sixth skill. Rich people design optionality into everything they do. This is subtle, but incredibly powerful. Optionality means structuring your decisions so that you benefit from uncertainty rather than being hurt by it. You want to be in a position where good surprises help you a lot, but bad surprises do not hurt you much. This is the opposite of how most people live. Most people make decisions that expose them to catastrophic downside while capping their upside. Let me give you a concrete example. Someone takes a job that pays well but requires 90 hours a week and offers no time to learn new skills, no time to build relationships, no time to explore other opportunities. They have sold all their optionality for a fixed salary. If that job disappears, they have no options. They have spent years building no transferable skills, no network, no alternative income streams. They optimized for today's paycheck at the expense of tomorrow's possibilities. This is the opposite of what rich people do. Rich people structure their lives and their portfolios to have many options. They maintain diverse income streams, so losing one does not destroy them. They invest time in learning and relationships. That might pay off in unexpected ways. They keep some resources available for opportunities they cannot predict yet. This looks inefficient in the short term. It is not maximizing immediate returns, but it is incredibly efficient over longer time frames because it lets you benefit from randomness. When an unexpected opportunity appears, and it will, you have the resources and flexibility to seize it. Everyone else is too locked into their current path to even notice. I will tell you about a decision Cool Joe made early in his career that illustrates this. Cool Joe was working in academia, comfortable on a tenure track. He could have stayed there forever. Predictable salary, predictable career. But he saw an opportunity to do something different, to apply mathematics to finance in ways no one else was doing. It was risky, very risky. He could fail spectacularly, but here's how he thought about it. If he stayed in academia, he knew exactly what his life would look like. The upside was capped, comfortable, but capped. If he tried this new thing, the downside was he would fail and have to return to academia or something similar, which was not actually that bad. But the upside was unlimited. This is asymmetric risk, limited downside with unlimited upside. The key is you need to survive the downside. You cannot take risks that destroy you if they go wrong. But if you can structure decisions where failure is survivable and success is transformative, you should take those bets repeatedly, because you only need to be right once for it to change everything. Think about it in terms of venture capital. A venture capitalist invests in 10 companies. 9 might fail completely. But if one becomes the next big thing, that one success returns more than the 9 failures cost. That is optionality at work. They are not trying to avoid failure. They are trying to get exposure to unlimited upside while keeping downside manageable. The seventh skill, and this might be the most important of all, is discipline. Rich people understand that discipline beats intelligence every single time. I have worked with some of the smartest people on the planet. Mathematicians who could see patterns in data that looked like random noise to everyone else. Physicists who could model complex systems with elegant equations. And I have watched many of them fail at building wealth, not because they were not smart enough, but because they could not stick to a plan. They got bored. They got emotional. They convinced themselves they could outsmart the system. They could not. The market does not care how smart you are. Here is what separates successful investors from everyone else. It is not genius. It is process. It is having a system and following it even when it feels wrong, especially when it feels wrong. Because the times when your system feels wrong are often the most important times to follow it. Let me explain why. Markets move based on collective human emotion. When everyone is terrified, prices crash below rational value. When everyone is euphoric, prices soar above rational value. Your feelings are just a reflection of what everyone else is feeling. So if you trade based on how you feel, you are buying high when you feel confident because everyone else is confident, and selling low when you feel scared because everyone else is scared. You are guaranteed to lose money over time. A disciplined system does the opposite. It buys when prices are low and everyone is scared, which feels terrible in your stomach. It sells when prices are high and everyone is euphoric, which feels like you are missing out on huge gains. But over time, consistently buying low and selling high is the only way to win. The problem is it requires you to act contrary to your emotions on a regular basis. Most people cannot do this. They know they should. They understand the logic perfectly. But when the moment comes, they feel the fear or the greed, and they break their own rules. I will give you a specific example from 2008, the financial crisis. Markets were collapsing. Every single day brought new catastrophic news. People were panicking, convinced the entire financial system would disappear. Smart people, educated people, people who should have known better, they sold everything. They locked in massive losses because they could not tolerate the emotional pain of watching their portfolios decline day after day. And I understand that pain. I really do. But here is the thing. If you had a system that said invest a fixed amount every month, regardless of market conditions, and you followed that system through 2008, you bought stocks at historically cheap prices, and over the next decade, you made extraordinary returns. The people who had discipline, who followed their system despite the terror they felt, they got rich. The people who trusted their feelings, they lost everything. This is why Cool Joe built trading systems that removed human emotion entirely. Computer algorithms do not feel fear. They do not feel greed. They do not read the news and panic. They follow the rules they are programmed to follow consistently without any deviation. And over time, that consistency compounds into massive advantage. Now, I am not saying you need to build computer algorithms for your personal finances, though honestly, it would not hurt. What I am saying is, you need to create rules for yourself and follow them as if you were a computer. Invest this amount every month, no matter what. Rebalance your portfolio every quarter, no matter what. Do not check prices more than once a week, no matter what. Whatever your rules are, follow them. Because every time you break your rules based on how you feel, you are paying a tax to your emotions, and that tax will keep you poor forever. Let me bring this all together for you, right now. Because these 7 skills are not separate ideas, they are a unified way of thinking about money and about wealth. Rich people treat uncertainty as mathematics, not as emotion. They are obsessed with finding where they are wrong. They think in probabilities, not certainties. They systematically exploit small inefficiencies that everyone else ignores. They understand and harness the power of compounding while actively avoiding erosion. They design optionality into every decision they make, and they have the discipline to stick to their systems, even when every instinct in their body screams at them to stop. Notice what is not on this list: working harder, being smarter, taking bigger risks, thinking positive thoughts. None of that matters in the way you think it does. What matters is thinking differently. What matters is seeing the world through mathematical eyes. What matters is having the courage to follow systems, not feelings. And what matters most is starting tonight to apply these principles to your own life. Because the mathematics of wealth do not care who you are. They do not care where you came from. They do not care how much money you have right now. They just work consistently for anyone who understands them and has the discipline to apply them. The question is not whether you can learn these skills. You absolutely can. The question is whether you will. The question is whether you have the courage to abandon everything you thought you knew about money and embrace a completely different way of thinking. The question is whether you are ready to stop being emotional about your finances and start being mathematical.